Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast for Morningstar. In this week's podcast, Christine Benz discusses how much you should have in cash and then shares her tips for stock exposure. Then, Russ, Kinnel, and Susan Dziubinski talk Wide-Moat funds. And finally, Dan Kemp fills us in on the crisis between Russia and Ukraine. Let's get started. Here is Christine Benz for Morningstar, Inc.
The next step in the process is to evaluate the adequacy of liquid reserves, so of your cash assets. The baseline for people who are working is 3 to 6 months worth of assets set aside in liquid reserves. I think sometimes people are put off by how high those numbers seem, that seems like a lot of cash. And I think the issue is that you really want to think about how much you could get by on in a pinch, rather than thinking about how much you're spending today while you're employed. The idea is that you're building yourself an emergency cushion of the expenses that would be absolutely essential if for whatever reason you were not able to earn an income, or if you were to become disabled. The idea is that you're building yourself an emergency buffer. For people who are retired, I like the idea of holding 1 to 2 years of living expenses in cash investments. If you wanted to run with a lower cushion, you could potentially take that down to 6 months worth of living expenses, but I think you would want to probably be a little closer to the 1 to 2 years worth of living expenses. A couple things to think about with respect to liquid reserves. One is that if you've gone through this X-ray process, you'll probably see that your cash weighting is higher than you thought it was, and that's especially true if you have active mutual funds in your portfolio. You don't want to take those residual cash balances into account when tallying up your emergency cushion. And the key reason is that you can't call your mutual fund and say, oh, equity fund, I would just like to pull out my cash holdings. It doesn't work that way, unfortunately. So you'd want to look at the amount that you have that's truly liquid. And then I think even though cash yields are very, very low today, it's also worthwhile just shopping around to make sure that you're getting the highest yield that you possibly can. And specifically, I think you want to be careful about some of the notoriously low-yielding cash accounts that are available, brokerage sweep accounts, for example. Even though they might be convenient, they're typically very low-yielding. So if you are a little bit thoughtful and willing to do a little bit of homework, you can probably pick up a higher yield on your cash securities. One thing that often comes up for retirees who want to maintain that cash cushion on an ongoing basis is where to go for that cash, how to replenish that bucket one or those cash reserves as they become depleted. So if you're spending from that cash bucket on an ongoing basis, how to top it back up. And I think that there are a couple of ways to go about doing that. One is to simply take any organically generated income distributions, whether from your bond holdings or from your dividend-paying equities, and have those sent over into your cash account. That way your cash account is kind of topping itself up on an ongoing basis. So even if you're not reaching for income, looking for income-rich stocks and bonds, you can still enjoy a little bit of income coming in the door through those income-producing securities. And then if you need additional cash reserves, and many investors certainly will because income is really low today, you can then use rebalancing annually to help top up the cash reserve. So you would pull from the very appreciated portions of your portfolio and use them to top up your cash holdings. For investors who are looking back on 2021, which was generally another great year for the stock market, pulling from appreciated U.S. equity holdings seems like a really logical place to start if you need to rebalance and you need to top up your cash holdings.
Expand your investing horizons and look to the long term with Morningstar's podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Now, Christine Benz reviews your portfolio's equity exposures.
The next step in the process is to assess your equity exposures. So we've talked about some of the tailwinds that U.S. large growth stocks have had. If you look at your portfolio style box exposure and you've been hands-off with your portfolio, if you haven't been periodically stripping back U.S. growth stocks, it's a good bet that your portfolio is skewing toward U.S. versus foreign. It's skewing toward growth versus value. And so you may need to do a little bit of repositioning to help restore balance. It may be that you have as an ongoing bias, a bias toward U.S. large cap growth stocks, that's your choice. But it's just important to be conscious of whatever biases you have in your portfolio. If you're seeking balance, if you're anticipating reversion to the mean, anticipating that growth stocks may cede ground to value and that U.S. stocks may cede ground to non-U.S. over the next decade, doing a little bit of repositioning there probably makes sense. So on this slide, I've got an indication of the extent to which U.S. growth stocks have outperformed value. They've nearly doubled value over the past 5 years. U.S. stocks relative to non-U.S. stocks have also trumped non-U.S. stocks. So those are areas to think about doing some repositioning, especially if you're kind of looking forward as opposed to using the rearview mirror to drive the car. Thinking in terms of your portfolio's fixed income exposures, the Fed's planned interest rate hike has certainly put pressure on bond prices. That started in late 2021, and that has certainly persisted into the early innings of 2022. We've seen some losses on bond funds just recently. So for the year to date, we've seen the biggest losses in terms of long-term bonds. They tend to be the most interest rate sensitive. We've also seen some weakness in emerging markets bonds recently, where they have fallen back just as much as long-term bonds. So I think the thing to remember is that even though the Fed has not taken action to lift interest rates yet in 2022, that investors in the bond market are often preemptive. So bond prices tend to factor in the market action. So we've seen bond prices take a little bit of a hit. I think it's important to review your portfolio's interest rate sensitivity. Most investors don't own long-term bonds as a portion of their portfolios, but it is important to understand the price effects that your portfolio might encounter during a period of rising interest rates. So I often like to point investors to what I call a duration stress test. And to do this, you don't need to be a bond market geek, but you need to find a couple of data points about the funds in your portfolio. So you'd find the duration of a bond fund in your portfolio, and you can find that on the portfolio tab of Morningstar.com. Find duration, and then also find a statistic called SEC yield, which you'll be able to find for ETFs, exchange-traded funds on Morningstar.com. For mutual funds, you'd want to look on your fund company's website for SEC yield. And the SEC yield is just a current snapshot of the fund's yield. And so you're taking those two numbers and you're subtracting that yield from the duration. And the duration is a measure of interest rate sensitivity. And the amount that you're left over with is the amount that you might expect to see that bond fund lose in a 1-year period in which interest rates jumped up by 1 percentage point. So that's a big jump up in terms of interest rates. But run your portfolio holdings through that sort of stress test. So if you have a long-term bond in your portfolio, long-term bond fund in your portfolio, you'll see a duration of roughly 18 years today, certainly a high double-digit duration today, and you probably see a yield in the neighborhood of 2% today. So running through that little bit of math, you'll see that that's a fairly significant loss in that 1 year period in which we would see a sizable interest rate jump of 1 percentage point. Most investors don't own long-term bonds specifically for this reason, for their potential volatility. Most investors own shorter term and intermediate term bonds, which tend to be much less interest rate sensitive. So looking at intermediate term bond funds today, we see durations oftentimes in the neighborhood of 6 or 7 years. Yields are pretty low, so yields don't provide too much of a cushion, but nonetheless, that leaves you with, I think, a little bit of comfort in terms of thinking about, well, how vulnerable are my fixed income holdings in a potentially catastrophic interest rate increase? It's probably something that you could live with. But nonetheless, run your holdings through this stress test. This will tend to be most useful if you have high quality bond funds in your portfolio. It'll be less instructive if you have lower quality bonds. While you're looking at your portfolio's fixed income exposures, it's also worthwhile to evaluate the role of lower quality bonds. I mentioned that lower quality bonds had been pretty resilient during this recent market sell-off. The issue to keep in mind is just how these bonds tend to perform in varying market environments. So one thing we know when we look at the data is that lower quality bonds are much more correlated to stocks than they are to high quality bonds. And so I think that can help you figure out how to use them in your portfolio. I like them as a portion of the equity exposure in a portfolio rather than thinking about them as higher yielding alternatives to high quality bonds. High quality bonds will tend to deliver ballast for your portfolio, so they're what you want to hold. If you want a portion of your portfolio that will potentially gain a little bit when stocks go down, low quality bonds will not do that for you. They will typically move in sympathy with the equity market. Even though they might not lose as much as stocks in market sell-off, they will tend to behave in sympathy with equities, which is one reason why I like investors thinking about them as part of their long-term portion of their portfolio. If you're a bucket investor, for example, you'd think about holding them in bucket 3 in that long-term piece.
Next, here are Susan Dziubinski from Morningstar Inc. and Russ Kinnel from Morningstar Research Services.
Hi, I'm Susan Dziubinski with Morningstar. At Morningstar, we're fans of companies that have wide economic moats. Such high-quality firms have competitive advantages that allow them to effectively fight off competitors. Several mutual funds keep a large portion of their assets in Wide-Moat stocks. Here today to share some of his favorite Wide-Moat funds is Russ Kinnel. Russ is Morningstar's Director of Manager Research and editor of Morningstar Fund Investor. Hi, Russ. Nice to see you today.
Glad to be here.
Now, Morningstar's stock analysts spend a lot of time talking about economic moats. So let's sort of start there, talking in general terms about what makes a Wide-Moat company and why that's attractive.
Yeah, so this is a concept popularized by Warren Buffett and borrowed with love by us. The basic concept is companies that are hard to compete with because they have big competitive advantages, they're established, and therefore hard to compete with, and that gives them a great defensive quality because it's hard to make a company like that go to zero or really take away their business. So that could be a thing like a name brand, like a Procter & Gamble or a Coca-Cola, very hard to get them off the grocery store shelves. It could be something like entrenched software, like a Microsoft, or it could be something like both, like a Apple or Facebook. If you have a better product than Apple or Microsoft, it still doesn't mean you're going to actually get all of their business because there's so much high cost to switching over, whether it's for an individual, like say, who wants to go from Facebook to something else, a business, imagine telling an IT person, get rid of all your Microsoft. So those make for very big competitive advantages, and we see that those are the sort of companies that endure.
So we're going to talk today about a handful of funds that own a lot of Wide-Moat stocks specifically. So is it intentional on the part of these funds in general to own Wide-Moat stocks, or is it more of just a byproduct of their overall strategies?
It's very intentional. They might call it quality rather than wide moats, but it's very much a part of their process. They're looking for companies that have these really strong characteristics because they are good long-term investments. It's no accident that most of these funds have very low turnover because moats endure. Procter and Gamble has had those advantages for a long time, as have some of these other companies. So you can find a good company like this and hold on for a long time.
So let's dig into some of the funds. The first one is BNY Mellon Appreciation. This fund lands in Morningstar's large cap blend category. And the fund has a little bit more of a growth tinged portfolio of about 50 names. Tell us a little bit about it.
Yeah, this is a fund that was formerly named Dreyfus Appreciation, but it's sub-advised by Fayez Seraphim, a well-known firm out of Houston, and they're very much focused on finding very high-quality names that they can hold on for a very long time. But they are valuation aware, at least relative to some of the other moat-oriented funds. So they end up in large blend. They even will hold a little bit of energy. But again, it's very well-established brands and a very patient approach that has really worked well over time, and it's a pretty stable firm as well. So you kind of have stability working on a couple of levels there.
The next fund is Jensen Quality Growth. This one also lands in the large blend category. And, based on the latest portfolio, it seems like it has a little bit better dispersion or balance between value and growth. But it's a little bit more concentrated, holds about 30 stocks, right?
That's right. This is a really nice quality fund. I own it. It's again very much focused on quality names, but you mentioned the concentration, and concentration in quality stocks to me is much lower risk than, say, concentration in high beta names. If say you've got really high risk stocks, whether it's a gold miner or a super fast growing company, that can make for a very risky portfolio. But when you're talking about wide moat names, again, they endure. So I think it's a pretty reasonable approach to just focus on the very best names you can find. So, Jensen is another one that has been a very consistent performer. If you look at their record, generally when there's a recession, they do quite well. In markets like the downturn we saw just recently, these wide moat funds don't do as well because wide moat, in a case like this, it's more of a valuation correction, and moats don't help you so much there, but they're more of a recession defense.
And then the last fund that lands in that large blend category for Morningstar is Vanguard Dividend Growth. It has more of that true sort of blended approach to portfolio building and also has a dividend focus.
That's right. Dividend growth is another way to get at wide moat stocks, because to find a dividend growing name, you need a strong balance sheet, but also the potential to grow that dividend. And that kind of leads you naturally to these kind of wide moat names that are well established, have big, robust balance sheets, lots of cash, but also the ability to grow. And so maybe technically they're not saying moats, but dividend growth gets you to the same place, and it still has those really nice defensive characteristics that I think gives you a lot of appeal. That in equities, obviously there's a lot of risk. These have less risk in general because of that. Whether it's dividend growth or wide moat, you just sort of ending up with companies with a lot of good defenses.
And now we're going to talk about a couple funds that land in our large growth category. The first being Poland Growth. And this one's really quite concentrated. This only owns about 24 stocks, right?
That's right. So it's our most concentrated fund. Again, I don't worry about it too much. We rate it silver because we think it can manage that concentration. They place maybe a greater emphasis on the ability to grow, and that gets them in the growth box. But they also care about they call it like fortress balance sheets. So very huge cash stakes, which of course could mean a tech company or a brand name company. But at the end of the day, this is a really nice growth strategy. Again, when you have wide moats, it's okay to concentrate, I think.
So, Russ, our last pick today, also in that large growth category, is actually undergoing a name change. So let's talk a little bit about that first. At the time of this taping, the fund is actually called Lotus US Large Cap Growth. Tell us about the name change and why it's happening.
Yeah, it's Schwab Select Large Cap Growth is the new name. It's not really changing. It's just a rebranding. Lotus has always been Schwab's brand name for actively managed funds, so they're just renaming it. It's an accurate name. It is a large cap growth fund. What we like is Lawrence Kemp is a very seasoned investor who's very much a focused growth investor. It's a little more aggressive than some of the other ones we've named, so maybe not quite as much defensive characteristics, but very much focused on good wide moat names with good growth characteristics. I think a pretty attractive large growth option out there.
And then lastly, Russ, I took a look at the year-to-date performance of these 5 funds. And with the exception of Vanguard Dividend Growth, the other 4 are landing in the bottom half of their respective categories this year, which may strike some investors as odd because they might be thinking in terms of, wide moat stocks, defensive plays. Why aren't these funds doing better in a choppy market? Can you talk a little bit about that?
Yeah, it's a great illustration of the ways they provide defense and don't. So this latest correction is mostly kind of growth names who had very high valuations getting cut, and price risk is not a thing that quality really protects you from. It protects you from recessions, because in recessions, these kind of companies look great because, say, in the financial crisis in '08, they weren't dependent upon banks because they have robust cash balances, but also they have brand names that endure through and hold up very well. Often, so if you think about people still buy Procter & Gamble or Microsoft or whatever, even in a downturn. So economic recessions, these are great defense, but they're not great defense against all types of sell-offs.
Well, Russ, thank you for your time today and for doing this deep dive into some of these wide moat funds. We appreciate it.
You're welcome.
I'm Susan Dziubinski with Morningstar. Thanks for tuning in.
Lastly, here is Ollie Smith from Morningstar UK and Dan Kemp from Morningstar Investment Management.
As Western governments prepare to impose and expand sanctions against a newly belligerent Russia, I'm here to ask Morningstar Investment Management's global CIO, Dan Kemp, what the knock-on effects are for markets and indeed investors at home. So Dan, thanks for joining us. Somber news emerging from the Ukraine. May I just start off with the big picture? How have markets reacted broadly to Putin's decision here?
Well, hello, Ollie, and you're absolutely right. Big news for the world today, and of course that's affecting markets as well. And as we look back over what's happened already today, the first thing to say is that it's been really noisy in markets. So overnight we had sharp falls in Asian equity markets. The UK market opened sharply down, as did the rest of Europe, and more recently through the course this morning we've seen some recovery there. US government bonds, which are typically a safe haven in times like this, the price has risen there, and of course energy prices, oil prices particularly, have risen. And so that's all understandable and all quite normal. I think the lesson of today, as ever, is not to get drawn in as investors to these short-term changes. So people who felt that the markets were falling and that they should sell first thing this morning would have been rapidly licking their wounds as they saw a recovery in markets. Equally, we may see a further leg down. It is the type of noisy market that draws people in and whipsaws people into making bad decisions. So a very dangerous time for investors.
Just sticking with commodities for a second, and oil and gas in particular, the price of oil has risen. So what is the precise relationship between a situation like this and commodity prices?
Ollie, we have to think about it on a couple of different levels. At the very surface level, then we see commodity prices rise because Russia is a large supplier of energy, particularly oil and gas, into Europe. And so when we see these geopolitical tensions, of course, people become concerned about supply, and therefore that leads to a price response. But if we dig below that level, of course, it becomes much more complicated. As you said, we have to keep an eye on what OPEC is doing, what supply is doing in the US as well, and also the fact that prices have risen very dramatically over the last 18 months following the trough, the height of the COVID crisis. And so people should never extrapolate future price movements from either past movements or from these geopolitical events, because it's so easy to get that wrong and to miss a change in sentiment in the market. So although it's not a surprise that prices have risen, don't assume that that will carry on regardless of what Russia does over the next few days and weeks.
Sure. And just finally, in terms of fund management groups, and I suppose your peers in the asset management world, it seems to me at the moment that nobody's really making any assumptions about what will happen next, even though Putin has clearly signalled his intent. Do you personally feel certain about an outcome either way here? Do you have a view on it?
Ollie, you can never be certain about the outcome. This is one of the great challenges of all investment, that as you look ahead, the future is uncertain. We believe that there may be a future that we can uncover through enough analysis, but that's simply not the case. We always have to think about the future as a range of probabilities. And so as we talk about other fund managers who haven't reacted yet, then that's probably a good thing. They're thinking about this range of outcomes. They're thinking hopefully longer term beyond these latest market wobbles and really into the deep value that we're seeing in markets and trying to understand what the fundamental drivers of returns are. So no, you can't ever predict the future, particularly over the short term, particularly when it comes to politics and energy and all that we're seeing around that noise at the moment. But what you can do is look at individual companies, look at asset classes, look a long way into the future and what the expected returns are from the fundamental returns of these businesses when you're given that longer timescale. So always focus on the long term. Don't get distracted by the market noise, and don't make quick decisions that you may live to regret later on.
Absolutely. Behavioural lesson for everyone. For more information and analysis of the Russia-Ukraine crisis, check out morningstar.co.uk. Until next time, thanks to Dan Kemp. I've been Ollie Smith for Morningstar.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.